In the last video, we learned about the normal distribution, the famous bell curve that's used in so many financial models. It looks neat, it's mathematically elegant, and if markets actually behaved like that, investing would be a whole lot easier. But they don't. In fact, markets have a habit of doing the impossible, surprisingly often. So today, let's talk about why real financial markets actually aren't normal and what people mean when they say markets have fat tails. Remember the bell curve? Most returns are clustered around the average, and as you move further away from the center, extreme outcomes become incredibly unlikely. According to a normal distribution, a massive market move should be exceptionally rare. Think of it like rolling a dice. Getting a 6 isn't that unusual, but imagine rolling 100 sixes in a row. That's the kind of rarity we're talking about when the bell curve predicts extremely large market movements. The problem is, markets seem to roll a lot more 160s than they should. This is where the idea of fat tails come in. Uh, Imagine taking the bell curve and stretching out both ends. Instead of the probabilities dropping off really quickly, they decline much more slowly. Those stretched ends are what we call the tails. And because they're fatter, extreme events become much more likely than a normal distribution would predict. That doesn't mean crashes happen every week, it simply means that they happen often enough that we can't ignore them. The probability of extreme gains and extreme losses is much higher than traditional models suggest. So why aren't markets normal? Because markets aren't controlled by random numbers, they're controlled by people. Millions of investors react to news, fear, greed, interest rates, company earnings, politics, wars, economic shocks, and sometimes even each other. Think about what happens during a market panic. People see prices falling, they start selling. That selling pushes prices down even further, which causes even more people to sell. It's a feedback loop. The same thing can happen during bubbles, where optimism pushes prices higher and higher. Human behavior creates extreme moves that simple statistical models struggle to capture. History gives us plenty of examples: the 1987 stock market crash, the 2008 global financial crisis, or the COVID market crash in 2020. Even events like the GameStop short squeeze. These weren't tiny deviations from the average. They were enormous moves that happened far more frequently than a perfect bell curve would predict. If markets truly followed a normal distribution, many of these events would be so unlikely that they should barely happen at all. Yet we've seen multiple examples within just a few decades. And this isn't just an interesting statistical observation, it has real consequences. If you underestimate the probability of extreme losses, you underestimate the risk. That means portfolios can look much safer than they actually are. Banks can hold too little capital, risk managers can become overconfident, and investors can be completely blindsided when something unexpected happens. Understanding fat tails is one of the biggest reasons modern quantitative finance has moved beyond simply assuming everything is normally distributed. So yes, the normal distribution is still incredibly useful, but it's a model, not a reality. Real markets are messier, more emotional, and far more unpredictable. In the next video, we're going to build on this idea by looking at two terms you'll hear all the time in quantitative finance: skewness and kurtosis. These are the statistics that help us measure how a distribution differs from the perfect bell curve. If you're enjoying this series, be sure to follow the money loop as we work our way from the fundamentals all the way to the concepts used by professional quants and risk managers. And I'll see you in the next one.